Hello, everyone. In this lecture, we want to talk about obtaining a vehicle. In life, most people want to or need to have a car for everyday life. Purchasing a car is likely to be the second most expensive purchase a person makes, the first being, of course, a home, and therefore takes some thought and planning. So, to obtain a vehicle, basically, you have two options. Either you can buy the vehicle, buy your favorite car, or you can lease the car. Okay, leasing the car, it means that you are actually renting the car. Okay, so it means that you do not own the vehicle, and you go to the dealership and you say you like whichever car, and uh, you sign a contract. It's called the lease, and on that uh, lease document, you promise to make monthly payments of like $400 or $450, whatever the amount is, and you also choose to make a down payment or not. Down payment is that initial amount of money you pay when you want to lease the vehicle or even buy a new car. So all these information and um, the term of the lease, which is like the number of years that you will be using the car, renting the car, whether it's 3 years, 4 years. The term of the lease is also written there. The interest rate that the dealership charges is there. So all this information, total amount that you have to pay, all these details, including monthly payments and all of that, is written in this lease agreement. Okay, um, and that's one scenario. Um, And about leasing a vehicle, we have to say that it has some advantages. Some people like driving a brand new car. They like the smell of that new car. So every 3 years they want to drive a brand new car. So they prefer to lease. Some other people they don't care about this and they prefer to buy. And the thing is that after the term of the lease is over, after 3, 4 years, you have to return the vehicle to the dealership because you don't own it. And then you give the keys to the dealership, and then you just take the bus, go home. That's how leasing works. Or maybe lease a second vehicle, sign a new contract afterwards. Um, and other things about lease, we can say that the car has warranty. So if anything goes wrong, the dealer is in charge. They have to fix it for you for free. And there's this buyback option that after 3 or 4 years you drive the car and you take care of the car, you know how well you have maintained the car. You have this option of buying the vehicle actually for a cheaper price. So you can negotiate and you can buy the vehicle. Or if you don't want to buy it, then you can just return the vehicle to the dealership and then they will sell it to somebody else. The other option is, of course, buying or purchasing a vehicle. And in that case, or other than leasing, as I say, you can purchase the vehicle. In that case, you have two options. Either you can buy a new car or you can buy a used car. Okay. When you buy a used car, you know that it has some disadvantages. It has a high mileage, a likelihood of it breaking down is high, and you don't know how well it has been maintained, and it is definitely out of warranty because the warranty for the car is usually 3 years. So when you're buying a car which is like 8 years old, so it doesn't have any warranty. Some disadvantages are involved, uh, but at least it's cheaper. That's the advantage. But when you buy a new car, then the price is very high. You have to pay uh, high amounts for the taxes. But then there's two options. Either you pay cash, let's say it's $35,000, you pay cash, you buy the car, you go home, no questions asked. Or if you don't have that much money, $35,000, maybe you pay $5,000 as a down payment, and the rest of it, which is $30,000, you can finance it. What does that mean, finance it? It means that you go to the bank and you ask for a car loan or something, and then the bank says, okay, we're going to give you the money, the $30,000, you give it to the dealer, okay? You buy the car, okay, and dealer is out of this equation, and then you start making us, that is the bank, monthly payments or biweekly payments. And of course, the bank is not doing this for free. They're going to charge you with interest, obviously. So that's the meaning of financing, which means you make the payment not in one big lump sum, just like when you buy cash, but it means that you make your payments in installments per month. So here we have an example. It says we want to buy a brand new car. Okay. The price of the car is $17,995. Okay, that's the price that the dealership is offering. It's often known as MSRP, manufacturer's suggested retail price, MSRP. That's $17,995. And because it's a brand new car, you have to pay HST on that. So when you're leasing a vehicle or when you're buying a brand new car, they are charging you with HST, which is the sum of PST and GST. So HST is harmonized sales tax, and that is the sum of provincial sales tax, PST, which is 8%, and the goods and service tax, which is 5%. So 5%, 8%, that's 13% tax you pay in the province of Ontario if you want to lease a vehicle or you want to buy a brand new car. But if you're buying a used car, then you do not pay the GST part of it, and you do not pay 13%. Instead, you pay only 8%. That is the PST only. Okay? So here, this is a new car. So we want to pay taxes. We have to pay HST, so full 13% basically. Okay? So here, if I want to calculate the cost of the vehicle with the tax, it's going to be $17,995, okay, times 1.13, okay, so that will be 17995 times 1.13, including HST tax, 13%. That would be $20,334. So $20,334.35. Okay, so this is how much you have to pay if you want to pay cash, buy the car on spot, including taxes. That much you have to pay. But you don't choose to do that. Okay, instead you have a down payment of $3,000. So you decide to pay $3,000 as down payment on day one when you're getting the car from the dealership. So if you pay $3,000, let's see how much is the rest. So $20,334 minus $3,000. That's the down payment. So we get $17,334.35. So this is the remaining amount that needs to be paid to the dealer, right? So you paid $3,000, okay, that was called down payment. Initially, you were supposed to pay $20,334.35. So the remaining amount, somebody has to pay, right? So this is the amount that you finance, okay? So this is amount financed, which means that you go to the bank and you ask the bank to pay for you, and then you start paying in the form of monthly payments to the bank, and you pay your loan to the bank later. So that's the scenario. So this is the amount that is financed. The cost of the vehicle with tax, we just found it. So this is the vehicle cost, including taxes, we just found earlier. And now the dealership itself can actually lend you money. You don't have to go to the bank. You know, you can even ask the finance department of the dealership to actually lend you the money. And when you go into that office and they you talk to the person in charge, and he's sitting behind the computer, does the calculation. He tells you that your monthly payment is going to be $398.41. So every month you have to pay that much. And then they ask you for how long you want this amount to be financed, after how many years you want to pay off your loan, basically. And you tell them 4 years. Let's say you choose 4 years. You can go 5 years if you want. So time is 4 years, and this is the monthly payments. Okay. And now we want to know what is the total cost of this purchase. We are buying a brand new car. What is the total cost? So I wrote the formula at the top. It says when you want to buy a car, the total cost of the buying is down payment plus the car loan repayment. That is the total amount you have to pay. And instead, when you are leasing the vehicle, the total cost of the lease is down payment again plus the regular monthly payments. That will be the total amount of cost for the lease of the vehicle. But in this example, we are buying a brand new car. So we're going to use this other formula. So we're going to say total cost of buying this new car is going to be the down payment, which was $3,000. And we have to take that into account because after all, you worked hard for that money and you paid it. So why shouldn't we be counting it? Plus car loan repayment. So the amount that you financed, either you borrowed money from the finance department of the dealership or from the bank or from another financial institution, but this is the amount that was financed, and they told you that you have to make monthly payments of $398.41. So $398.41. They have a special software. Okay, they use a special program to do the calculations. They say this is how much you pay every month. Now, how long? 4 years. Okay, but this is the monthly payment, right? And every year has 12 months. So it's going to be 4 years, every year 12 months. That would be 48 payments, each one $398.41. Okay, so if we use a calculator, we can figure this out. The 3,000 plus 398.41 times 4 times 12. So that would be 22,123.68. Okay, so this is the total cost of the new car that you are going to end up paying, actually. Okay, $3,000 was the down payment. That's the down payment plus car loan repayment, which is 48 payments, each one of them $398.41. So when you add them up, the total cost of buying the brand new car is $22,123.68. So in this story, you may think, okay, why should the bank or the dealership or the financial institution lend you the money? Why should they give you the money? Well, the answer is because they are charging you with interest. They don't like you that much. They like your business. They want to make money by doing business with you. So if you want to know how much interest you end up paying, it's not difficult to figure this out. The vehicle cost, okay, including taxes, was $20,000, right? And you already paid $3,000. We count that. So basically, if you would pay another $17,000 roughly, you would be done. But you didn't, okay? And as a result, you ended up paying $22,123.68. So a car which was worth $20,000, you could have bought it, with that price. Now, technically, after 4 years, you end up paying $22,000. Imagine what would be the price of the car if you would buy it cash. $20,000, $20,334. That would be the amount you would pay on day one, cash, buy the car, go home, right? But instead, what happened is that you paid part of it and then you financed the other, the remaining part. And now when you're calculating the total cost of buying this new car, you end up with $22,000. So a simple subtraction would give you the amount that you paid extra in interest. So the amount of interest you paid was $22,123.68 minus $20,334.35. 20,000 would be the amount that you would buy cash, but you didn't do that. You ended up paying $22,000, including the down payment. So a simple subtraction here will tell you how much extra you paid, and that is 1789. So 1789 and 33. Okay, so this is the amount of interest that you paid, and now you know why the bank or the finance department of the dealership lent you the money. Why did they do that? Because of this amount, because of this money, because they wanted to make some money out of this business, and that is the amount of interest they charge you for an amount of $1,789.33. Okay, so hopefully you understood the calculations of buying a brand new car. And in the next lectures, I'll try to give you examples of scenarios where you buy a used car and another scenario where you are actually leasing a vehicle. Okay, thank you.